Let me ask you about the US bond deal, because that's consuming a lot of investor attention these days. Do you think most of it is played out in that run up to 3% plus, or is that something which can inject a lot of volatility yet by surprising on the upside?
Well, our expectation is that the path will be slow of interest rates up from here for the reasons that I said. And the inflation picture, as far as we can see it, is relatively muted in the US and elsewhere. However, there is more upside pressure than there's been for a while, and that's both in wages, because of the strength of the corporate sector at the moment, but it's also oil prices, and that shift in oil prices over the year has been quite strong. And that is coming through in some way into input prices. So there is a bit more upward pressure at the moment. However, it's really, when it comes down to what will shift the bond yields, is a combination of that inflation expectations, but it's also supply and demand. And so that's, as we go through the year and we see the increased supply of treasuries coming to the market, that will be a big determinant of where those interest rates or the bond yields go. And for the moment, we think that will be managed. And so if there is a big sell-off, then that program will be adjusted.
If I had to ask you to guess, and it's only a guess because these things are impossible to predict, how far are we away from the next US recession?
Well, we do ask ourselves, this within our strategy group, and at the moment, we can't see it in the next 12 months, and that's really as far as we look when we are doing macro forecasting. So we can't see it at the moment because you've still got an environment which is supportive with monetary policy, less so than it has been, but it is still supportive, and you've got a fiscal boost coming through as well. So we can't see it at the moment.
But does the bull market fade into a bear market synchronously with signs of a recession popping up, or well before it happens? If you're saying it's 12 months away maybe, or more than that.
Could be more.
Could be more. So when does the bear market kick in? Because most investors worry about the first year of the bear market, which typically takes away 2 or 3 years of gains. You think that would be a couple of years away, or it could now start to get priced in slowly?
Well, the best guess at the moment is that it is really flat rather than either a bull or a bear. And so you can go through an extended period of really not going anywhere, but with more volatility. And at the moment, that looks like our best guess of the environment that we're in. However, it's difficult to see it being better than that. And it's, as you go on through time, easier to see it being worse than that. But that's the best guess at the moment.
What's easier to pick right now? A US market which is probably past its peak, or emerging markets adjusted for risk, maybe at a slightly lower end of the growth cycle? In a relative sense, what's easier to make an investment call on?
Well, really what we're looking for is the growth and valuation, and with a quality sort of hurdle. And you can find growth in the US, but it's not cheap. And you can find some value elsewhere, but you need to make sure you're finding growth as well. At the moment, because of the big run-up that you've had in all markets, it's difficult to find both of those things in the same place. And so that's really what we spend all our time looking for. But that valuation angle is definitely more of a challenge now than it was 5 years ago.
Sure. At this stage of the cycle, do PEs tend to compress, or do you get market returns which are more or less in line with the kind of earnings that you're getting?
It's the latter. So at the moment, you would expect you're just holding where you are on PEs, and that's after a period where you have had some compression, particularly because of that US tax reform, which was a major boost to earnings this year. Can't overemphasize how much it is. So you had a sort of 3-point derating in the US market just on the basis of that. So you've had that sort of compression. From now, it looks to us like it's going to be growing in line with those earnings, and then as we go forward, if we do get more upside on the bond yields, then you might see a bit more compression on the Ps.
Does the political landscape look more challenging to you as an investor, or more unpredictable as an investor?
Yes, I think it certainly does. And that is one of the reasons I said why we think we will get some more volatility. Certainly the advent of Donald Trump as a president of the US has led to more uncertainty about all policy. And so that is something we can't second guess what he's going to do. So we need to just look at the portfolios that we have and the stocks we're looking at to see where the relative exposures might be to that.
What would make you relook at your hypothesis that we are now going to amble through maybe in a period of subpar returns, but it won't be anything drastically bad, or neither is it a roaring bull market? When would you sit and reassess, saying something new has happened and we need to relook at this hypothesis?
I think it's trade. If we really do see a big escalation in tit for tat between the US and China, then I think that would call for a reassessment, because it could mean a direct negative impact on growth as a whole, but on some particular sectors like technology, specifically, and because that has been such a big driver of markets and still is, that I think would definitely cause us to reconsider.
And what is your own assessment of whether that risk plays out or not?
It looks certainly a higher risk now than it was 12 months ago, and so it's something that we really do need to be thinking about and taking some action, taking some profits out of some of the highest momentum names that we've got, which are really very exposed to that. So some of the areas where we've been taking some profits out over the last few months have been some areas like semiconductors, which are very much in that sort of line. Plus they are have done very well, and this cycle in some areas is rolling over a bit.
In a phase like this, what is investment strategy that you've chosen? Have you become more defensive in your portfolio positioning just to ride through this kind of period that you just described?
We don't tend to shift the beta of the portfolio around very much, so we don't tend to take too many directional bets in the portfolio. And we're always looking for we have a philosophy, we're always looking for growth, we're always looking for quality, and we're always looking for some valuation upside. But in this environment though, I think that quality threshold, which we always have, is probably going to be just tweaked up a notch. And although over time you can't prove that having a quality focus is a particular benefit to returns, there are times when it certainly helps you avoid disasters. And I think we are going into a time where that quality threshold is going to be more important and will be more beneficial in allowing us to avoid torpedoes.
Lucy, it's been a great pleasure. Thank you very much for your time today.